Brian Tan, and today we're going to be going through a comprehensive legal and tax checklist to maximize your end of financial year. We will be joined by our in-house legal and accounting experts, James Pham on the accounting side and Damin Murdock on the legal side in the next few minutes. Just as everyone comes into the presentation, I will launch a quick poll to get some feedback on your business and the biggest focus and priority so we can tailor these webinars as well. Just while everyone's entering the webinar and completing the feedback poll, we do have a chat box and the Q&A open right now. So if there's any questions on preparing and maximizing your business for end of financial year, tax returns and legal structuring, etc., feel free to put any questions, comments in the chat box, in the Q&A box, and towards the very end of the presentation, we will get to those. We also do have an exclusive webinar offer for end of financial year, which we will present straight after the presentation by both presenters, keeping in mind that any purchase made on a Lawpath subscription product can be claimed at 120% on your business tax return. This strictly does end on June 30 from the ATO as well, so keep this in mind. Just a bit about Lawpath. You're likely familiar with what we do. We've been in business for the last 8 years, serving over 300,000 Australian businesses, saved over $100 million in legal fees. And we've done this through our contract management system, which has access to over 450 templates now. And we have our in-house legal and accounting experts. So if you ever need to get some advice or a contract review, or simply to seek, clarification that you're on the right path, you can do that through our legal advice plan and our legal advice and accounting plan. We do have additional services that we're offering, such as trademark registrations, business services, and company registrations as well. So just getting started on our mission to help small businesses access legal and accounting. Now, just lastly, some topics to cover today. We'll be going through our end of financial year accounting planning, so how to get your accounts in order, different things to consider before June 30, things like superannuation payments, etc. We'll be going through end of financial year legal planning with Damin, reflecting on your business structure. We'll be covering unpaid debts owed to the business, how you can plan ahead, how Lawpath can help, and then lastly, a Q&A at the end of the session as well. So lots to cover today. And without further ado, I will pass it over to James Pham. He's the head accountant at Businesse, who works with Lawpath for our accounting clients. Thanks for your time, James.
Thank you, everyone. Hello, welcome to the end of financial year tax and accounting presentation. Today, I'm going to be going through everything you should be thinking about as a business owner in terms of tax and accounting at the end of financial year. So we are 14 days away from end of financial year. And now's the time to start looking at your tax positions and start planning for the 2024 financial year, okay? Next slide, please. So first things first, during this period of the year, April and May, it's called tax planning season. So us as accountants, we engage our clients to go through a process called tax planning, okay? So what does that process usually look like? It involves first step is an estimation of the taxable income for all the individuals and entities within your group and within your business. Okay, so that might involve forecasting or estimating remaining revenue in the year and expenses. And once that's done, you have a rough taxable income figure. You will calculate the tax payable on this income. Okay, and then once that's calculated, you have a look across the group and see how you can find ways to reduce tax, whether that be through income spreading, whether that be through tax deductions, things like that. And it's a balance of seeing if a tax deduction makes sense, because again, tax deductions do involve cash output. Okay, so an accountant will usually run a few scenarios for you based on the estimated taxable income, and then it will involve a meeting and running through those strategies and seeing which levers you would like to pull. Okay, so in the next few slides, I'm going to go through some common tax reducing strategies that are quite standard within the industry. So moving on to the next slide, the big one, temporary full expensing. Okay, so this is a measure that was introduced during COVID to promotes economic activity, promotes spending. It replaces the depreciation rules that were in effect before. Yes, there was an instant asset write-off where there was a threshold of $30,000 for the value of the asset. During the temporary full expensing rules, that threshold has been removed and there's no limit on the value of depreciating asset that you can write off, okay? One thing I will say about this is it is expiring on 30 June 2023. So if you were to buy any assets and you wanted a full write-off or tax deduction for the value of that asset, it needs to be done before the end of financial year, because once 30 June ticks over, it reverts back to the normal depreciating rules, okay? So there generally aren't any limits on the assets you can deduct. The only real restriction is the car cost limit. So there is a limit on how much you can write off on the value of a car. And for the 2023 financial year, that is $64,741. So if you purchase the car for $80,000, your tax deduction is capped at $64,741. Okay, and this applies to new assets and secondhand assets as well. Okay, so it's a great way if you do need a piece of equipment or an asset within the business. It's a good piece of legislation that will allow you to get a full write-off within a year, especially if you are profitable and you are looking at a tax bill. It's a great way to reduce that tax bill. Again, it all comes back to if you do actually need the asset within the business. Okay, moving on. Here we have a simple example of how the temporary full expensing rules reduces tax. Okay, so the asset purchase here is going to be a car. It was purchased on the 23rd of June 2022. The cost of the car is $50,000. Okay, it doesn't matter that the car was financed. That's separate. You'll be able to claim a deduction once the car is installed and ready for use. Okay, so again, it needs to be 100% business use. And in this example, the profit in the company is $30,000 before the purchase of the car. So if this business did not purchase the car, the company tax would have been $7,500, which is $30,000 taxed at a 25% flat rate. But using the temporary full expensing rules and claiming the full value of this purchase as a tax deduction, it creates a loss of $25,454, okay, and which means now that the company tax is nil. So what happens is the company will lodge a tax return showing a loss of $25,000, and then that loss is carried forward to future financial years to be offset against future profits. Okay, moving on. Now, there was also another measure introduced during COVID. This is the tax loss carryback provisions. What these rules, it's essentially a cash injection back into businesses. So the government allowed any businesses that incurred a loss, if you made a loss in the 2022 financial year, you were able to get a refundable tax offset on any tax paid in prior financial years. So again, with this was meant to interact with the temporary full expensing rules. So you could create a loss in the 2022 financial year, and then you can carry back that loss to any tax paid in prior years. So the key thing here is you had to have had paid tax in the prior financial years, and it doesn't count that you have a tax liability and it's outstanding. It needs to have been paid. Okay, so that's the key rule there. You can carry this back as far as the 2019 financial year. So if you paid tax in 2019, 2020, or 2021, you can carry back a 2022 financial year loss backwards. So generally, losses are carried forward, but due to COVID, the government allowed tax losses to be carried backwards, okay, to get a refundable tax offset. Next slide, please. So here's a practical example of the carryback provisions. Okay, so we'll use the prior example where the motor vehicle created a tax loss in the 2022 financial year of $25,454. Assuming the company made a profit and paid tax on $30,000 in the 2020 financial year, you can carry back this loss and you will receive a tax refund of $6,363.50. Okay. So that's just 25% of the tax loss there. And again, this, as I said, the tax had to have been paid already, okay, in order to get this refund. Moving on to the next slide. Another very common tax minimization strategy is superannuation. It's a great way to reduce tax and also save money, plan for your retirement as the money is going to your super fund. The things to note here are there is a cap for each individual. So there is a concessional super cap, which is $27,500 every year. There are rules in place that allow you to carry forward any unused concessional contributions from prior years. So you'll need to check what your balance is before you make those contributions, and you'll get a tax deduction for those contributions. Okay, so key things here are the money actually has to hit the super account before the end of financial year, and your super fund, if you're making a personal contribution for in your individual name, you need to submit a notice of intent to claim to your super fund and notify them that you are going to make a personal concessional contribution, and you are intending to claim a tax deduction for this contribution. Okay, so the benefits of this is, I'll show you in the next slide. So we can move to the next slide. So contributions are taxed in the super fund at 15%, whereas you get a tax deduction on them at a higher tax rate based on your marginal rate. So if you're sitting in the 32.5% marginal rate and you make a personal tax contribution, then you are net benefit of 19.5%. So on this example here, an individual has a taxable income of $100,000. He decides to contribute $20,000 as a super contribution. The tax benefit of this is going to be $3,900, and that's going to be the 20,000 multiplied by that 34.5%. Whereas that 20,000 is going to be taxed at 15% in the super fund. So there's a clear percentage benefit there if you do make superannuation contributions. The only thing here is, again, the money goes into your super fund and you are not able to touch it until you reach retirement. So I think that's something to consider there. Moving on to the next slide, income splitting. This can only be utilized if you have the structure in place. So generally, if there's a family trust involved, or if there's a family trust, or you have a bucket company involved, you can distribute income or split income across beneficiaries within the trust. And this works well if you have children who are 18 years old and not earning any income, or a spouse that's not earning any income. You can distribute income to them. Okay. This also works for a company. If you have a spouse that is doing administrative work for your business, you could pay them a salary as well. Moving on to the next one. Yes, so low income tax offset. So you may have noticed that there used to be a low to middle income tax offset. That's gone now. There is only the low income tax offset now. So this will be automatically applied in your tax return. You don't have to do anything. You don't have to apply for anything. So it will apply automatically in your tax return when you fill out your income information, okay? And it'll be automatically applied to your tax return. Moving on. Okay, so now we're going to move on to sort of a checklist that you should have, or you should complete before the end of financial year in order to start planning for the next financial year, okay? So you need to ensure that all the bookkeeping is up to date. You need to make sure that you close off all financial accounts. Any invoices that need to be recognized this year are raised, any bills, any superannuation that needs to be paid off, any wages, things like that. You want to make sure that you have closed off the financial accounts, or you're thinking about closing off the financial accounts as we approach the end of financial year. Because now is the time to start thinking about the next financial year and things that you want to put in place to help your business grow. So things like budgeting, forecasting, reviewing your financial performance, looking at pricing, looking at your cash liquidity, or making a decision on whether or not it's time to restructure based on the tax planning process. Okay. Moving on. Another thing that might be different this year is work from home expenses. So in the past 2 years, we've had a nice 80 cents per hour shortcut method from the ATO. That's now been advised to 67 cents per hour, okay? So there's a few ways you can calculate work from home expenses. You can use the ATO fixed rate method, 67 cents, or you can actually calculate the business portion of your actual expenses, okay? One thing I do want to mention is if you have a company and it's a home-based business and you are trying to claim rent on your for your business, then if you own the property, then I wouldn't advise that you do that because it does affect your main residence exemption. However, if you are renting, then that's more of a viable solution if you are a home-based business. Because if you own the home and you rent that home, the office space to your business, then your home becomes an income generating asset, and that will affect your main residence exemption. Okay, next slide, please. Yep. So another thing to check off, you want to make sure that your tax obligations are up to date. So speak to your tax accountant, make sure your BASs are paid, or your IASs, activity statements. If you have outstanding debt and you would want to get your accountant to negotiate a payment plan for you, so the ATO knows that you're committed to paying. They don't fine you for any late lodgements or non-payment. They are aware. The ATO is generally very lenient in these situations. So if you are able to demonstrate a good relationship with the ATO, then they'll be very welcoming in terms of offering you a payment plan. Okay. Yeah, so just on this, make sure you're up to date with your lodgements. You don't want to be incurring any interest or non-lodgement penalties with the ATO. Yep, moving on. Okay, so this is forward-looking. We always advise our clients to set up a budget or a forecast. So what is a budget? A budget is a set of goals, income goals and expense goals, month to month. So it sort of gives you a benchmark of where you should be hitting. So if you are not sure on how your business is performing, you should really look at the ATO benchmark data, as it gives you a view of what other businesses in your industry of similar size are doing in terms of revenue and expenses. And it gives you a goal on how to hit those benchmarks. Okay, so benchmarking and budgeting is a great tool for business owners moving forward. It allows them to have a goal to reach, essentially. And forecasting, again, is going to be sort of more of a useful tool because you are able to estimate cash flow and predict cash flow into the future based on revenue estimations and expense estimations. So this is all done through looking at historical data and applying any benchmarking and tax obligations and moving and forecasting that out into the future, so that you have an idea of where you are going to be in the future if you do hit your budgeting goals and revenue goals. Okay, so if you don't engage in budgeting or forecasting, you are essentially flying blind into the future. You don't really know where you should be or where you are heading. So it is a very good tool to have when you're managing your finance affairs. So an accountant can definitely help you with this. This is where accountants provide the most value, I believe, when looking at financial information and converting that into a budget or a forecast. Okay. Last thing I want to touch off on is it's very specific to the current labor market that we're in now. It is a tough labor market. Wages are increasing, labor costs are increasing. So I want to talk about reducing costs via outsourcing. So if we move to the next slide, Ryan. Yep, so outsourcing is a great option to reduce labor costs. Outsourcing is great for tasks that are heavily administrative or are involved in software development. So you should always speak to an advisor when looking to bring operations offshore. So we work with a great partner called Remote Highly, and they will be able to help you build an offshore team essentially for your business. And yeah, so moving on to ongoing advice and support, I think it's crucial that businesses engage with an accountant. So I work on the legal and accounting advice plan, and we offer 30-minute calls with our clients. And this is an invaluable resource. It's a resource for you to get advice, to bounce ideas off an expert, someone who has experience in the industry. So yeah, get in touch with us if you are interested in jumping on the legal and accounting advice plan. So now I'm going to pass it off to Damin to go through end of financial year legal.
Thanks, James. Hi, everybody. So today we are talking about the end of financial year. I'm just going to make sure my audio is on and everybody can hear me. All right, so let's have a look at what we're going to focus on today. So we want to reflect on your business structure, whether you have some debts. We want you to start planning, talking about organizing your business for the capital raise that you might undertake this year, and also some of the trends and new laws that are in place. So the first one is we'll talk about your business structure. So it might be that you're a sole trader, you've decided to move into a company structure, you've done that this year, or maybe you're looking at doing it. One of the things that we normally talk about is right now is the time to consider whether you should do that restructuring. The reason is primarily because of tax issues. So you might want to do your corporate restructuring on this side of the year, or possibly on next side of the year, and it's going to come down to what your current tax situation is. So for instance, if you have been running a company and you want to get a family trust in place, and your company is extremely successful, it looks like it's going to be extremely successful, you haven't done your tax returns yet this year, and you really want to be able to take some of those profits and distribute it to possibly your spouse or your children or things like that, similar to what James was just talking about, then it might be that you want to get that trust established immediately on this side of the year, issue new shares to that trust or issue new shares to your spouse, so then you can pay the dividends on this side of the year to split that income. Or it might be because this year wasn't that successful, you might want to worry about the corporate structure on the next side of the financial year. But it really is important that you talk to an accountant and see if you want to do that income splitting, if you want to do that new corporate structure, whether you do it on this side of the year or the next side of the year is really important, because you're going to be either saving in capital gains tax, saving in possible sales tax in terms of the sale of your shares if you're going to be doing it that way. And you really need to know what your situation is before you go ahead with that structure. So if it's something that you were considering, talk to your accountant right away. You still have 2 weeks. You might be able to pull it off in the next couple of days. Also, if you've made any changes, so if you've issued new shares to anybody, if you've transferred any shares and you haven't informed ASIC, remember you got to do it right away. If you don't, for every 28 days that pass, a penalty applies. So I've had a situation where someone had to pay $13,000 in penalties because they originally set up their company incorrectly and they went to go change it, and the ATO or ASIC charged them $13,000 in fines for going back about 13 years. So have a look. If you change your address as well, if you change directors, make sure your company structure is up to date with ASIC. Next slide, Brian. Now, this time of year is when a lot of companies find out whether they did well or whether they didn't do well this year. It might be that haven't done well in reconciling their accounts. They might have fallen foul to putting all their invoices in, and they're now trying to gather up everything with their accountant. And it could be a case where that accountant says, look, you're insolvent trading. Your business is not sustainable, and we need to probably close it down, because otherwise, if you are insolvent trading, so you're continue to trade when you can't pay your debts, then the director can be personally liable. And so if one of your clients has sit down with their accountant in the next few weeks and their accountant says, well, you're insolvent trading, you got to close it down, that's a problem for you. And the reason it's a problem for you is that if you're owed money, then you're not going to get it. So we always say the squeaky wheel is the one that gets the oil. So you want to look at all your debtors. You want to see Well, if they owe you money, is it because they are insolvent trading? And if so, you need to urgently take steps, which includes issuing a statutory demand, which is a demand for payment within 21 days. And if they don't pay it, then you can appoint a liquidator who's your friendly liquidator, take control of that business and can help recover your debt. But if the debtor puts their own liquidator in, you probably have less chance of ever recovering any money. So one is consider whether you need to chase the debts right now. And if so, there might be a way to do it where you can take urgent steps, which allows for the collection of those debts within 21 days. Generally, only a lawyer can do that. It's called a statutory demand. You can Google it. Lawpath, I'm sure, has an article on that as well that you can look at. And then the other thing is whether you actually even want to collect your debts. It might be a case that you've already made enough profit this year. You actually don't want the money to be paid. So there's a difference of how you've established your company from an accounting perspective. Are you on a cash basis or are you on an accrual basis? If you're on a cash basis, you're only paying tax based on the money that you actually receive and the expenses that you actually pay out. That's how you would be calculating your profit. Whereas if you're set up on an accrual basis, it's set up on when you actually issue your invoice and when you actually receive invoices. So if you're on a cash basis, or even if you're on an accrual basis, you might decide that it's not worth issuing an invoice right now because you're going to end up increasing your tax. And you might want to put it on the other side. So just have a look at what your current accounting position is. And if you need to collect those debts, get onto it right away. You got 2 weeks. You can get a lawyer to issue a letter in the next week and chase that debt before the end of financial year. What's also interesting is that right now, if you go through your bad debts, you might see that there's a lot of debtors. And this is a good time to reflect to determine, well, why do you have those bad debtors? And it's probably because your terms and conditions are failing in certain respects. It might be that your payment terms are too long. There's no reason why a client needs to be paying on 30 days from the date of invoice. You can reduce that down to 14 days or 7 days. There's no real rule of thumb that says that you have to give them 30 days to pay. In fact, if your payment terms are 30 days to pay, then you should change it, because the reality is you issue your invoice at the end of the month and then you wait 30 days to get paid. That could be up to 60 days to get paid, and it hurts your cash flow. So have a look at your terms and conditions. Has there been a lot of disputes this year? Does your terms and conditions include what's included and exclude what's excluded? I know a lot of people probably question that, but a lot of the times people don't have the exclusions in their agreement. And as a result of not including the exclusions, there ends up being disputes and a misunderstanding of what is included, what's not included, especially if you're a service business. So take some time, have a look at your terms. If you're having bad debts or you're meeting with your accountant and you're finding that people are paying you late, then have a look. It's probably because your terms and conditions are failing. And that's it for bad debts. So next slide, please, Ryan. So looking at planning ahead, working from home policies is an interesting one. A lot of people like Elon Musk and so on have said that working from home is not working. And a lot of the employers are looking to bring back people into the workplace. And if that is the case, well, the question is, well, can you do it? What's the rules? What's the policy? What's the procedures in starting to bring people back? So if you have 2 days from the office and you want to up it to 3 or 4 days from the office, how do you actually do that? Well, the first step is look, do you have a work from home policy? And if you don't have a working from home policy, it's probably the right time to implement it right away, which gives you the discretion to change it. Most people who are under a modern award has a consultation clause. That means that you can't just change your mind tomorrow and say, okay, now we're going to do 4 days in the office, because that's called a major change to the workplace. And you normally have to consult with your staff and tell them this is what's going to happen and give them time to process it. They might have children, they might have to change daycare, their spouse might look after the kids, whatever it might be. You need to give time, and you might want to start implementing that if it's your intention to start bringing people back. It's also time to look James was mentioning about buying assets. If you need new computers, monitors, stationery, whatever it is, if you want to reduce your profit, right now is a perfect time to do it. It's also a time to consider, well, if your staff needs new equipment in home, you might want to consider buying those assets for them as well, if they're for the workplace, to reduce your profit as well. So have a look at your work from home policy, what those arrangements are. COVID, it's rampant again in Sydney. I'm not sure where we're going to go with the vaccinations, but it might be worthwhile to have a look and see whether you have any kind of vaccination policy. All the policies I talk about are in the Lawpath platform, I believe. So you can have a look at those and get access to those. Same with the business plan. James was talking about having an opportunity to sit down with an accountant, have a look at how you did this year, start planning for what your wages are going to be, what your expenditures are going to be. Wages are all going up. So on the 1st of July, if your staff are on a modern award, all their wages are going to go up. So you're going to need to update your Xero or whatever other software you use. You're going to need to revisit the salaries. Also, a lot of employers are looking at CPI increases. So to keep your staff happy, you might want to look at the CPI increase. You might want to be considering giving your staff either a salary increase or possibly a bonus. Again, if you want to reduce your profit on this side of the year, it might be worthwhile giving a commission or a bonus payment on this side of the year to reduce the tax to reflect the CPI changes, or possibly reconsider doing a salary increase in the new year. And then in relation to shareholders, if you have shareholders and you haven't given them an update, they shouldn't really expect an update until you get your tax returns done. But your tax returns are based on your bank statements as of the 30th of June. So if you want to play with your numbers, essentially with your accountant, and you say, oh, I'm going to have a meeting with my accountant in July, that's too late. The reason it's too late is it's based on what your bank statements say. So it's based on the money that's in your account. It's not necessarily an opportunity to play around with the numbers on the new year. So just make sure you talk to your accountant if you have one, to make sure you've done everything you can to minimize your tax on this side of the year. Next slide, please. Now, some of the things that have changed recently and some of the things that are incoming that I'm just going to give you a quick summary on. So if you're a director of a company, you need to get your director ID. That was required last October. Fines will start to apply if they haven't already. So you can get your director's ID by under your MyGov account. Lawpath has an article on it. If you have any questions, you can contact Lawpath, but if you're a director of a company, you must have a director ID and you must go get it. In terms of remote witnessing, we've seen the laws come in place where almost in all states have now enacted laws that allow for electronic witnessing. And we also have new laws in place regarding the elimination of sexual harassment. So not only was this generally a requirement under occupational health and safety that everybody has to have a safe workplace, we also now have new laws in place that says that the employer has a positive duty to take reasonable steps to prevent it, and they must have measures in place to take remedial action. That means that at a minimum, you must have a sexual harassment and discrimination policy implemented in your business. So you have to get a policy, you got to notify all your staff of that policy, and you got to have in that policy the procedures on how to resolve any disputes or have a separate grievance procedure to deal with situations like this. This is a bare minimum that everybody needs to have as quick as they can so that they comply with the law. And if you have any questions, post them in the Q&A and I'll answer those after this. Also, just recently, we now have new flexible work arrangements that are allowed. So for instance, if you have staff working from home and you say, okay, we're going to bring back the staff from 2 days a week to 4 days a week, and someone says, well, look, I want flexible working arrangements where I don't have to come back. You can't just simply say, well, tough luck, that's the rules. This is our work from home policy. You got to come back. You can't, because the employee can now make a request to work from home, or have flexible hours. And now there's a positive obligation on you, again, to consider it, respond back in writing, explaining why you're not going to approve it or why you are going to approve it. And there's a limited circumstances where you can actually refuse it. And if you do refuse it, there's an opportunity now for your employee to go to the Fair Work Commission to make a complaint about your refusal. So if you are planning on changing that, it's important for you to deal with your work from home policy in a process where it's going to be able to deal with these flexible working arrangements that have come into place. Unfair contract terms as well. So if your terms and conditions say something like you're locked in for a 12-month contract, and if you terminate early, then you have to pay us out the entire 12 months. Or if your contract has a clause that says something like your contract's on a 12-month term and it automatically renews for a further 12 months. Those two clauses, one's an automatic renewal clause and the other one is a penalty clause. Those may be unenforceable. And there's new powers now that are in place that one can void the entire contract as a result of these unfair contract terms, or can put an injunction on you, restraining you from enforcing that clause against all future clients and customers. So it's important for you to, again, to look at the contract. You can Google unfair contract terms, consider whether you have possibly implemented an unfair contract term. It's normally one that's found in the click to accept, which is called a click wrap agreement or a standard form contract. It's normally those contracts that these unfair contract terms apply. And there's also penalties that are applying. And the last one is just remember the minimum wage is increasing. So if you have employees that are on a modern award, you're going to have to update those. Next slide, Ryan. And lastly, if you have anyone on a fixed term contract, which is 1-year contract, and then you renew it for another year, they've now implemented laws where you can't have a fixed term contract for more than 2 years. Otherwise, they're going to be deemed permanent employees. There are some exemptions, such as if it's a specialist skill or they make more than $162,000 a year, things like that. But if you run your business for years on fixed term contracts and you just keep on automatically renewing those fixed term contracts with your employees, then you're probably going to have to change your ways, and those new laws will probably apply to you. Also, salary secrecy. You can't prohibit your employees from discussing what their current salary is anymore. And we now have family and domestic violence leave, so that if anyone ever has approached you and says that they have issues at home regarding domestic violence, then they will be allowed to have up to 10 days off per year. One other thing is, generally speaking, right now, if you are a small employer with 15 or less employees, or less than 15 employees, and you had someone that brought a claim for an unfair dismissal against you, they need to be employed for a minimum of 12 months to be able to bring that claim. Alternatively, if they make a salary that's more than $162,000, they cannot bring a claim at all against you for an unfair dismissal. Now that $162,000 changes every year, and it's due to change again on the 1st of July, which will be increased slightly to maybe $165,000 or something like that. But if you have any senior staff who are getting paid, let's say $164,000 or $165,000 or $162,000, and you don't want them to ever be able to bring an unfair dismissal claim against you, it might be worthwhile for you to give them that salary increase so they exceed that threshold by $1. And in those circumstances, you might only have to up their salary by $1,000, but at the end of the day, they're now prohibited from bringing an unfair dismissal claim against you. So just by paying $500, you've protected yourself from an unfair dismissal claim. So if you have any of these really high paid salaried employees, it's worthwhile to have a look at this because you can protect yourself a little bit. And then finally, and last one, is that there's new privacy bill, and that essentially says that there's higher penalties. So if you breach privacy, they can charge you 3 times the value of the benefit you received as a result of breaching the privacy, or 3 times your salary, or up to 50 million. And I think that's it. Next slide, Ryan. Yeah, that's it. So I'll pass it back to Ryan. Thanks everybody for joining.
Thank you so much, Damin and James, for the great presentation. Lots of information, and we have some questions coming in. So if anyone has any questions for Damin or James, please pop them in the chat and the Q&A. Just wanted to cover off briefly on the budget boost for business. Like I mentioned at the start of the presentation, any Lawpath subscription, as you can see, there's 4 main services we offer. These are claimable at 120% as a tax deductible amount on your annual tax return. This is for an annual payment. If you do elect to do some monthly payments, or you've made partial pro rata payments, then only the amounts that have been paid before the end of financial year can be claimed on the tax return at 120%. This is a fantastic offer that is running. It is truly a one-off. It was announced as a budget measure last year and will not be repeated into the next financial year. So some of the deals that we've got going on as part of our end of financial year offers, we are offering a quarterly accounting and legal advice plan. So in the past, it has been a monthly plan for a year's commitment. We are offering 3 months of advice. So if you do want to get on board and have access to James and the accountants at Pop Business and Damin, Pham, and all of our lawyers on the legal advice plan to receive unlimited legal calls, video calls or phone calls, and a 4-page document review, as well as getting access to all of our templates library and an ASIC agent service where company changes can be done on your behalf. The quarterly plan is available. It's $293 per month. It's paid upfront for the quarter, and if you do that before June 30, you are able to claim the full amount, $879, as a 120% tax deductible amount. If you do want to prepay for the year and get that expensed as well at 120%, you can do it at $2,068. This does reflect nearly $1,500 discount on the standard monthly rate if you do elect in for a monthly payment for a year. So we do have those 2 offers on for the accounting, especially if you do need to make some changes right now. You do need to make superannuation payments, and they need to hit the accounts before June 30, or if you have any other considerations, don't leave it until June 30 to make these decisions. Jump on board immediately, book in a consultation and a discovery call with James, Damin, and also receive access to our accelerator program to take a more proactive stance on the business. So if you are interested in either of these offers, please key yes into the chat box. One of our team will be in touch with you on how you can proceed with these and then book in your discovery calls this week. We do have 35% going off our documents library. So if you're just after standard templates at the moment, or perhaps you are after the legal advice plan without the need for accounting, there is a 35% off both of those plans. And then lastly, if you are on a range of our plans, we do have a one-time deal to upgrade for a fixed amount. So if you are on the Essentials plan, it's a one-time payment of $480 for 12 months access. We do have the virtual office going at a discount as well. So if anyone's interested or has questions as an existing subscriber, please key it into the chat and one of our team will reach out from our legal services department this afternoon. So again, thank you for everyone for joining and for attending today's presentation. I'll just open the floor up to any questions for James and Damin. I do believe we have one from Nish to start off, James, on cash and accrual accounting.
Yeah, so there's a question here. Is it better to set up tax payments on a cash or accruals basis? Pros and cons for each option. Okay, so this really depends on your business and the nature of your business and the industry you're in. So just briefly, cash basis, what that means is you are assessed for GST and tax when the cash actually hits your bank account, as opposed to accruals basis, where this is the GST and tax is assessed based on invoice date. Okay, so the difference is it's really a timing difference. Okay, so it matters on a quarterly basis for your GST when you lodge a BAS, and then on a end of year basis when you're finalizing the income for the year, whether or not you're on a cash or accruals basis for tax. Obviously, if it's cash, so obviously if you've issued invoices close to the end of the year, but you haven't received the cash yet, it will depend on whether which method you're accounting for. Will change the number for the income that you assess in either side of the financial year. Okay, so pros and cons of each. I mean, for most small businesses, we advise that they go on a cash basis. So that means that they are assessed for GST once the cash actually hits their bank account. Only time I would say that an accruals basis is beneficial is if you have a business and you have suppliers that allow you generous payment terms, for example, 60 to 90 days, then it's a great way to boost cash flow in your business through GST credits. So, for example, a restaurant or a hospitality business that has an alcohol supplier that allows them to pay 60 days, they're able to claim those GST credits within the quarter, and then they don't have to actually pay the bill until after the quarter. So it's a great way to get the money in first. On the income side, doesn't really matter. It's just a timing difference, really. So if you offer favorable payment terms to your clients, then it might be better to be on a cash basis, since you won't be able to collect the money once based on the invoice date. So it really depends. It's a very personal question. It's a very individualized question. Yeah. So moving on, I see there's a few questions in the chat, so I'll just go into the chat here. Okay, so I have a question here. To use the tax loss carryback from 2023 financial year to 2021 tax return. Okay, so no, you don't have to amend your 2021 tax return. It is done in your 2023 tax return. So the tax loss carryback provisions, you do not amend the prior year returns. You just apply for it in your current tax return that you're carry the loss, and there's a section there that you fill out which year you're carrying back that loss to. There's another question here. You've also mentioned that the debt for the year has to be paid first. So if they just paid now, can they still use this loss anyway? Yes. So if you pay the tax bill before you carry back that loss, then yes, you can still apply it. Yeah, you can use the loss carryback provisions as long as the tax is paid by the time you lodge your 2023 tax return. You can use it. You can apply. You can carry back that loss. Okay. I believe there's a question about flexible work policy. So maybe Damin can answer that one.
Flexible work, a great policy. You might as well just simply implement one now. So if you don't have one, it doesn't matter whether you've had one or don't have one, just implement it now. There's nothing wrong with that. Whatever you're going to implement now should probably reflect what the current situation is. But then you need to make sure you have some clauses that allows you to change it at your discretion. And the Lawpath platform has an example one that will deal with situations where you can revert everybody back home for it, or back to the office, for instance.
Thank you. Yes, we will be providing a copy of the slides after the session, so don't worry about that. You will receive that. There's a question here. Can you change cash or accrual basis during the year or at end of financial year? Yes, you can. You can change your accounting method for GST during the year. I believe you can only do it at the beginning of the financial year, so it will have to be in the September quarter, and then there may be restrictions on changing it back. So if the ATO is yeah, so there might be a turnover limit that allows you to change your GST accounting method. So if you are a business below that turnover threshold, you can change your accounting method, but if you're over that, you may not be able to. Okay, so really depends on what type of business you are. Yeah, and then there may be restrictions on how many times you can change it as well. So you can't be changing it every quarter. So if you change it at the beginning of the year, I think you have to stick with it for that year and reassess next financial year. Okay. Are there any final questions? There's one here. I see one here. Okay, so if you bought a car for business and personal, can you claim a percentage of temporary full expense?
12 weeks.
Oh, yeah. It depends on where you purchase the motor vehicle. So if you purchase it under the company name, then obviously the business will, it depends on the percentage claim. So first of all, if you purchase it under the business, you will get a tax deduction for the value of that car, but then you'll be liable for what's called fringe benefits tax. Okay. And with fringe benefits tax, you will need to keep a logbook for the 12 weeks, which is representative of the business usage of the car throughout the year. And then if you're doing this through a sole tradership or your individual, then yeah, you still have to keep a logbook just to work out the claim and tax deduction that you are allowed to claim in your tax return. Okay. I think that's it. There's a question here. Does the subscription include tax lodgement assessment? Unfortunately, no, the subscription does not include tax lodgement assistant. It's a separate cost. Okay. It's for consultations only. Thank you, Michael. Thank you for the comment, feedback. Any last questions? No, okay. No worries. It was a pleasure to host this webinar for everyone. Hope you all got a lot of value out of it. We'll end the session here. Thank you everyone for attending.
Thank you everyone for attending the webinar today. I'm just going to launch a quick feedback poll so we can garner some feedback on the presenters and different topics that you might like to see. I saw we had a comment, someone wanted some webinars run on the disability support sector from an accounting perspective. So if so, please fill that out in the feedback column and we can continually make these webinars great. We are hosting a bunch more webinars coming into the final 2 weeks of end of financial year as well. So if anyone has any further questions for Damin or James, please key them in now. Otherwise, we will put a full recording of this presentation on YouTube by the end of the week, in which you can access the slides as well. So thank you everyone for attending today's Lawpath webinar.
Thank you.